Hello friends, Namaste. You're watching Jasuja-PropEquity and I'm Samir, your real estate friend, real estate philosopher and real estate guide. Today, we're going to address a question that every investor thinks about all the time. Where should you invest your money for the best returns? And trust me, this Diwali video is all about that. Today, we will break every myth that these financial influencers make because they also provide a half baked picture to justify their point. Our video is built on solid, real data that no one can challenge because for the first time ever, we have factual data comparisons of four major asset classes: fixed deposits, gold, the stock market, and of course, real estate. What makes our video different is that we have analyzed data across these asset classes for the past 25 years and have broken it down for every 5-year period within those 25 years so that nobody can argue that we have favored one over the other. This video is about hard facts covering multiple economic cycles, and no one can challenge these numbers. We have all heard the same old arguments again and again. People say real estate is an illiquid and lumpy asset class. Some say stock markets are the best. Others prefer gold, and few risk averse investors stick to fixed deposits. So, today we are here to debunk these myths using four extremely important points, which will clear all your doubts for good and help you become that savvy investor. So we request you to stay right till the end as all these 4 points are linked to one another, and this video can potentially be a part of your Bible, Gita or Quran for future investing. The first point we cover is which is actually the best asset class to invest in. Number two, some people say stock market and gold gives the best return over a medium to long period of time, but no one actually tells you how long that period should be: 3 years, 5 years, or 10 years. Number three, we will prove to you that all these asset classes are cyclical and can also have a down cycle or poor phase for a very long period of time. And lastly, how long should you hold that asset for and when to exit if you're caught in a down cycle. Let's start with gold, a traditional favorite seen as a good hedge against inflation. And in India, it's more than just an investment. It's very auspicious to buy during festivals like Dhanteras and Diwali. Next, we have fixed deposits, the go-to choice for many Indian risk-averse investors. They offer guaranteed returns, usually between 6 to 8%. Here, the risk is absolutely zero and thus lower returns. Then there are the stock markets, the favorite of our all ill-informed financial influencers, which offer the potential for good returns. But as we all know, with good potential comes great risks of losing even your capital. And that's why there is a disclaimer attached to stocks and mutual funds.
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
And finally, we come to real estate. It's more than just a safe investment. It offers security, a roof over your head, which is an absolute must, and gives great returns. And if you add leverage, which is only possible in this asset class, rental income, and tax benefits to the mix, this investment becomes truly exceptional. And guess what? We haven't even considered these benefits in our calculations because every influencer will try and prove that we are biased. Before we disclose the numbers, we would request you to like, share, and subscribe to Samir Jasuja PropEquity for more such data-driven analysis and insights. Now let's compare all the four asset classes, and for the purpose of our viewers, we will explain what we have taken in each asset class. For example, with respect to gold, we've taken the price of 24 karat gold for 10 grams, which today is at about 8,000 rupees for a gram. With respect to stock markets, we've taken the Nifty 50, which is a composition of the top 50 stocks of the country, the largest cap and the best performing companies of India. With respect to real estate, we've taken three super luxury complexes that were launched at different time frames. Remember, we've taken apartments which, according to everybody, appreciate the least. As per people, plots and farmland appreciate the most. But just to prove how much real estate can appreciate even in its lowest asset class, which is apartments, we've taken that example. Also, we have not taken any leverage or any rental yield or any tax benefits into our calculations. And with respect to fixed deposits, we've taken a yield of 7%. Typically, banks are offering that rate for a period between 1 year to roughly about 3 years. It typically varies between 7 to 8%, but for this purpose, we've taken 7% as an annual yield. So let's start first with the presumption that if you invested your money for 25 years without taking it out. So if you had invested in a fixed deposit in the year 2000, you would have had a return of 407% over the last 25 years, which would mean an annual growth rate of 16%. If you would have invested the same money in gold from 2000 to 2024, which is roughly about 25 years, you would have made 1712% overall, which means an annual growth rate of 68%. If you would have invested the same amount in Nifty 50, you would have made a staggering 2005% in 25 years, which is an annual growth of 80% on simple interest. Finally, for real estate, we've taken an apartment complex in Gurgaon. This complex is called Aralias. This is on Golf Course Road, and this was launched in the year 2000 at 1800 rupees a square foot. Today in 2024, it is at 55,000 rupees a square foot. And if you would have invested in this apartment complex, you would have had a growth of 2,956%, which is an annual growth of 118%. I would like to point out here once again that with respect to the real estate, we've not taken into account any leverage, any rental return, or any tax benefit which is available if you buy a real estate asset. Now let's move on to the 20-year time frame. If you would have invested in a fixed deposit in 2005 and continued to remain invested till 2024, you would have got a growth of 262% on your principal, which is roughly an annual yield of 13%. In the same time frame of 20 years, if you would have invested in gold, you would have got a return of 1039%, which is an annual growth rate of 52%. If you would have invested in Nifty 50, you would have made even a higher return. You would have made a return of 1135% in 20 years, translating to an annual growth of 57%. And during the same time frame, there was a second complex that was launched called Magnolias, again on Golf Course Road, another apartment complex which was launched at 4,500 rupees a square foot. Today it trades at 65,000 rupees a square foot. So your net gain would have been 1,344% over 20 years, and that means an annual growth rate of 67%. Now let's look at the 15-year time frame. If you would have invested in 2010 into a fixed deposit and stayed invested till 2024, you would have had a growth of 158%. That means your principal would have grown 11% year on year. During the same time frame, if you would have invested in gold, your return would have been 331% in 15 years, which translates to an annual growth of 22%. If you would have invested in the Nifty 50, your return would have been even higher. This would have been 368% from 2010 to 2024, translating to an annual growth rate of 25%. And finally, if you would have invested in another complex, which is Magnolias again, because there was no new launch at that time, the prices of Magnolias in 2010 had gone up from 4,500 to 9,000. So we take the base rate as 9,000. And today in 2024, it stands at 65,000. So your return would have been 622%, translating to an annual growth of 41%. Now let's look at the 10-year time frame. If you would have invested in fixed deposits from 2015 till 2024, you would have had an overall growth of 97%, translating to an annual growth of 10%. If you would have invested in gold in the last 10 years, the total growth would have been 203%, translating to an annual growth of 20%. Here also the stock markets have scored better. The overall growth in the last 10 years in stock markets has been 206%, and the annual growth has been 21%. Now let's come to real estate. And the most talked about complex, Camellias, was launched in 2015 at 20,000 rupees a square foot. And we all know today it stands at 1 lakh rupees a square foot. So in the last 10 years, it has grown by 400%, translating to an annual growth of 40% year on year. Finally, let's look at the last 5 years now, i.e., from 2020 to 2024. If you would have invested in fixed deposits during the same time frame, you would have had an overall growth of 40%. Annualized growth would have been 8.05%. If you would have invested in gold, the overall growth would have been 64%, translating to an annual growth of 13% year on year. If you would have invested in the stock markets, that's Nifty 50, your growth would have been 103%, which is twice that of gold during that same time frame, with an annual growth of 21%. And finally, I'm taking Magnolias back again, which was trading at 23,000 rupees a square foot at that time. Today it's at 65,000. So the growth is 179%, translating to an annual growth of 36%. Here I have not taken Camellias or Aralias because if I would have taken those projects, their appreciation is even higher. So to reduce the real estate appreciation a little bit, I have taken Magnolias as an example. And from all these 25 years broken down into all the intervals, it clearly comes out with facts and data that real estate has had the highest appreciation, whether you look at a 5-year period or a 25-year period or any period in between. And remember, once again, I haven't taken any rental income, any tax benefits, or any other leverage benefits also while calculating these numbers. And lastly, I'd like to say that there'll be a lot of people who'll say that Samir always tries to show real estate in a better light, but that's not the case. This is data talking. And I've taken apples to apples comparison. While I have taken super luxury apartment complexes, supposedly we should not appreciate the maximum because they are already at very high rates. They've clearly demonstrated that they have been the best performing assets. I have taken apartments and not plots and farmhouses, which are supposed to appreciate much more than any other asset class. And when I mean apples to apples, I've also taken the top 50 blue chip companies of the country and I've taken 24 karat gold. So nobody can say that I have taken a different type of asset in a particular asset class and compared to another different type. Now let's come to point number 2. Whenever your advisors tell you that you have to hold on for a long period of time, they never tell you how long it should be. 3 years, 5 years, 10 years. And let me tell you, it can be even more longer if you want to achieve your desired returns. Let's take example of gold. From the year 2012 to 2019, if you had entered buying gold in 2012, over a 7-year period, you would have only got a return of 1.7% in terms of annuity. Compare that to fixed deposits where you would have got a 7% return. So sometimes you can get caught in down cycles, and those down cycles can be very long, and then you have to stay invested no matter what. Otherwise, you will lose even fixed deposit type of returns, which are the bare minimum in the market. These kind of examples are just not in the markets with respect to gold. Let's look at the stock market now. If you would have invested in 2007 when the Nifty was 4,800 and stayed invested for 10 years right up till 2016, your annualized return would have been only 6.7%. That's an overall 10-year return of 67%, which doesn't even beat inflation. During the same time frame, like I said, if you would have invested in a fixed deposit also, you would have made better returns than even the stock market. Now let's look at point number 3, when I said that sometimes you get into a very bad down cycle, which I've mentioned before in point number 2 also, and sometimes you can also have negative returns, which means that you can lose your capital as well. If you had invested in the stock market in the year 2013, you would have had a negative return of 5%. That means you would have lost 5 rupees on every 100 rupees that you spent. That continued in 2014 as well, and you would have lost another 5 rupees, that's 5% there. And in 2015, the markets went down further by 6%. So if you total those numbers, that's a capital loss of 16% in 3 years, let alone getting an inflation equivalent return. You lost 16% on your capital, and that's on a 3-year time horizon. And you would have heard this from many financial advisors that please stay invested from 3 to 5 years and you'll at least make 12 to 13% compounded. So guess what? If you would have invested in 2012 and stayed invested till 2016, you would have been on a negative capital appreciation. Now let's look at the bad years that gold has had. So in the year 2001, gold went down by 10% from its capital value. In 2009, it went down by 38%. So imagine if you would have bought gold for say 10,000 rupees in 2008, in 2009, it would have been only worth 6,200. Gold has witnessed another down cycle in 2012 at a negative 12% and in 2016 with a negative 1%. So even in gold, which is supposed to be a very safe asset class, you had negative returns for certain years. So you have to be very careful and know exactly when to enter, how long to stay, and then take an exit. And that's what I'm going to try and cover in point number 4. So if you ask me, by looking at all these examples of various time intervals, one must invest in every asset class. You should be well diversified, and maximum should go in real estate clearly, because the maximum returns are in real estate and it's the safest asset. It doesn't have much capital depreciation ever if you hold on to it, which has been seen in the stock markets and even in the gold markets. Secondly, what should be a good return? According to me, a 15% annualized return on a simple basis is a good return. So if you have, for example, invested for 10 years and you made 150%, you're good and you can take an exit. But if you made 70%, that means you've caught in that down cycle, and it will be wise for you to stay invested till you don't achieve that catch up return that is required on your principal to make you achieve that 15% annualized. To reiterate, my advice to you is that a 15% annualized return on a simple basis is good. So if you're caught in a down cycle, wait till you get your 15% annualized and stay in that asset class. Remember, all these asset classes are cyclical in nature, but they do definitely have a catch up and they give you that return and much higher returns, even so, by shown in the previous examples. I hope you found this video insightful. Thanks for watching And this is Samir signing off.